The most powerful financial figure in America just said 6 words that made Wall Street go silent. And if you have money in stocks or a retirement account, what happens next could determine whether you retire comfortably or work until you're 80. Jerome Powell just broke one of the biggest unwritten rules in central banking. He commented directly on stock prices, and what he said deserves your attention, not your panic. During a speech in Rhode Island, Powell was asked about market valuations, and he said, "Equity prices are fairly highly valued." Now that might sound boring, like typical Fed speak, but let me explain why those 6 words matter and what they actually mean for your money. The Federal Reserve almost never comments on stock prices. They talk about inflation, employment, interest rates, but they carefully avoid saying whether stocks are cheap or expensive because the moment they do, markets react. And Powell just did it anyway. That's not an accident. That's a signal. That's a warning wrapped in diplomatic language. But here's what you need to understand before we go further. This isn't a prediction that the market will crash tomorrow. It's not even a prediction that it will crash this year. What Powell did was acknowledge a statistical reality that every serious investor already knows. Markets are expensive by historical standard. That's a fact. What happens next? Nobody knows for certain, including Powell. But history gives us patterns worth understanding, and those patterns are screaming caution right now. The last time a Fed chairman warned about overvalued markets was Alan Greenspan in December 1996, when he famously asked about irrational exuberance. You know what happened after that speech? The market didn't crash. It tripled over the next 3 years, reaching genuine bubble territory. People who sold everything after Greenspan's warning missed massive gains. That taught an entire generation of investors to ignore Fed warnings and just keep buying. But here's the part they conveniently forget. The bubble eventually did pop. The NASDAQ lost 78% of its value from peak to trough. Companies that people thought would dominate the world went bankrupt. Entire fortunes evaporated, and the people who stayed fully invested took more than a decade to break even. Some stocks never recovered at all. Ask yourself if you can afford to lose half your portfolio and wait 10 years to get back to where you started. Most people can't, especially if you're close to retirement or planning major life expenses. So Powell's warning doesn't mean sell everything today. It means understand where we are in the cycle and adjust your expectations and risk accordingly. It means recognizing that the margin for error is razor thin when valuations are this extreme. Let's look at the actual numbers, because facts matter more than fear. The Shiller CAPE ratio, which measures stock valuations by averaging earnings over 10 years to smooth out economic cycles, currently sits at about 40. Let me put that in perspective for you. That level has only been surpassed during a few specific periods in history. The years clustered around 1929, 1999, and we're approaching those levels now. The Great Depression, the dot-com crash, those are the only times stocks have been this expensive. The average CAPE ratio over the 20th century was 15.21. We're at 40. That means stocks are trading at roughly 2.5 times what history says is normal. Think about that for a moment. Every single time we've been at these levels or higher, major market disruptions followed. But here's the nuance that matters, and this is where most panic sellers get it wrong. High valuations don't cause crashes. They don't mean the market will definitely fall next week or next month. They just mean future returns are likely to be lower than average. The CAPE ratio was actually designed by Nobel Prize-winning economist Robert Shiller to forecast long-term returns, not to predict crashes. And research consistently shows that when the CAPE is high, returns over the next 10 to 20 years tend to be modest. When it's low, returns tend to be strong. Right now, with the CAPE at 40, historical patterns suggest you might see returns of maybe 2 to 4% annually over the next decade. That's before inflation. After inflation, you might actually lose purchasing power just by holding stocks and waiting. That's not terrible, but it's nowhere near the 10% historical average that most retirement calculators assume and that most people are counting on. This is why Powell's comment mattered. He's not saying run for the exit. He's saying adjust your expectation. If you're planning your retirement assuming 8 to 10% annual returns, you might be disappointed. If you're taking on massive risk because you think stocks always deliver great return, you're ignoring what valuations are telling you. And if you're counting on your 401k to grow at historical rates over the next decade, you need to understand that starting from high valuations makes that much less likely. Now let's talk about what's actually happening in markets right now, because the story is more complex than just everything is overvalued. Bank of America Research released analysis in late September showing the S&P 500 is trading at statistically expensive levels on 19 out of 20 key valuation metrics. 4 of these metrics just reached all-time highs. Think about that. Out of 20 different ways to measure if stocks are cheap or expensive, 19 say expensive. Not just expensive, statistically expensive, meaning the odds of this being sustainable are incredibly low. That sounds terrifying until you understand what it actually means. Expensive doesn't mean about to crash. It means the margin for error is slim. Companies need to deliver strong earnings growth to justify current prices. If they do, stocks can keep rising. If they disappoint, there's a long way to fall because there's no valuation cushion to absorb bad news. The AI boom is a perfect example of this dynamic playing out in real time. Nvidia's market capitalization is now roughly 6.7% of the entire US stock market. One company, nearly 7%. That's extraordinary concentration in a single name. If Nvidia stumbles, if AI doesn't grow as fast as expected, if competition emerges faster than anticipated, the entire market could crater just from one company underperforming. That's not diversification, that's concentration risk on a scale we've never seen before. It's actually worse than the late 90s when Microsoft and Cisco dominated, because at least back then, there were multiple big tech companies sharing the gain. Now it's Nvidia and a handful of others carrying the entire market higher while everything else struggles. Is Nvidia overvalued? Maybe, maybe not. The company is genuinely profitable, unlike many dot-com stocks in 1999 that had no earnings at all. It's benefiting from a real technological shift, not just hype. AI is transforming how businesses operate, how software is written, how decisions are made. This is real. But the question isn't whether AI is real. It's whether current prices already reflect years of perfect execution and growth. And if Nvidia stumbles, if competition emerges faster than expected, if AI monetization takes longer than hoped, the entire market feels it because of that massive concentration. When one company represents nearly 7% of the entire market, its problems become everyone's problem. Here's what makes this situation different from simple bubble narratives that you hear on financial media every week. The economy is actually performing reasonably well right now. Unemployment remains relatively low. Corporate earnings have been solid, exceeding expectations in many cases. Inflation has come down significantly from its peak in 2022, though it remains above the Fed's 2% target. Consumer spending continues. These are not the conditions that typically precede immediate crashes. Crashes usually happen when something breaks, when there's a crisis that forces panic selling. The 2008 financial crisis happened because banks were failing and credit markets froze. The COVID crash happened because the entire global economy shut down overnight. Right now, what we have is expensive markets in a decent economy. That can persist for years. It did in the late 1990s. The warning signs were visible in 1996 and 1997, but the crash didn't come until 2000. And this is critically important. It also means that when something does go wrong, there's less cushion. When stocks are cheap and something bad happens, they might not fall much because they're already priced for problem. Investors expect bad news and it's already reflected in prices. When stocks are expensive and something bad happens, the falls can be severe because prices assumed everything would go right. Markets priced for perfection have no room for disappointment. And right now, we're priced for perfection across most sectors, especially in technology and AI-related names. Let's talk about the economic and political landscape that makes this even more precarious, because there are several factors converging that didn't exist in previous cycles. First, we're heading into an environment of persistent trade tensions and tariff uncertainty. The US has maintained significant tariffs on Chinese goods, and there's ongoing discussion about expanding tariffs to other trading partners. Tariffs raise costs for companies and consumers. They disrupt supply chains. They create inflation pressures exactly when the Fed is trying to control inflation. Companies have been stockpiling inventory to get ahead of potential tariff increases, but that can only go so far. Eventually, those stockpiles need to be sold, and if demand softens, you end up with excess inventory, falling prices, and margin compression. That's not a recipe for the earnings growth that expensive stocks need to justify current valuation. Second, the U.S. government debt situation is becoming increasingly constraining. The national debt now exceeds $34 trillion and continues to grow. Interest payments on that debt are approaching $1 trillion annually because the government has to refinance maturing bonds at current interest rates, which are significantly higher than they were just a few years ago. During COVID, the government could borrow at near zero rate. Now they're paying 4 to 5%. That means more tax revenue goes just to servicing debt, which means less money for everything else, which means slower economic growth over time. And slower growth with expensive stocks is a recipe for disappointment. Companies that are priced for perfection need perfect conditions to justify their valuation. They're not going to get perfect conditions. They're going to get higher rates, constrained government spending, and eventually a recession, because that's how economic cycles work. They always have and always will. Third, and this is perhaps the most underappreciated risk, we're in a completely different inflation regime than we were during the 2010s. For more than a decade after the 2008 financial crisis, inflation was dormant. The Fed could print unlimited money and buy unlimited assets because there was no inflation risk. That playbook worked beautifully. Markets crashed in 2020 during COVID, the Fed printed trillion, and markets recovered quickly. But that was possible because inflation was low. Now inflation is structurally higher. Supply chains are less reliable. Labor markets are tighter. Energy costs are more volatile. The Fed can't use the same aggressive playbook without risking an inflation spiral. Let's talk about what Powell can and can't do, because this matters enormously for understanding what comes next. The Federal Reserve has one major tool to support markets during crashes: cutting interest rates and, in extreme cases, printing money to buy assets. They used this tool aggressively during COVID. They cut rates to zero and bought trillions in bonds and mortgage security. It worked. Markets recovered quickly, actually faster than anyone expected. But they can't do that again right now, at least not as aggressively, because inflation is still above target. If the Fed cuts rates too much too quickly while inflation is elevated, they risk losing control of prices entirely. That would create a different kind of crisis where both stocks fall and your dollars lose purchasing power simultaneously. That's called stagflation, and it's one of the worst outcomes for investors because you can't hide anywhere. Your stocks lose value and your cash loses purchasing power at the same time. This doesn't mean the Fed is helpless. It means their options are more constrained than they were in 2020. They have less ammunition. If markets fall, but inflation stays high, they face a genuine dilemma: support the markets and risk higher inflation that could spiral out of control, or control inflation and let markets find their own level, even if that means significant decline. Powell's comment about high valuations might be his way of preparing investors for the possibility that the Fed won't rescue every decline the way they have in recent years. It might be his way of saying the Fed put, that implicit guarantee that the Fed will support markets, has limits this time around. The geopolitical situation adds another layer of uncertainty that investors are largely ignoring right now. We're in a period of heightened global tensions. The relationship between the US and China remains strained. The war in Ukraine continues with no clear resolution. Middle East tensions are elevated. Any of these situations could escalate unexpectedly, creating market shock. In normal times, when valuations are reasonable, markets can absorb geopolitical shocks because there's a cushion. When valuations are extreme, any unexpected event can trigger disproportionate reactions because nervous investors are looking for reasons to take profits and reduce risk. Energy markets are another wild card that deserves attention. Oil prices have been relatively stable recently, but the underlying supply and demand dynamics are precarious. OPEC production decisions, geopolitical disruptions, transition to renewable energy, all of these create uncertainty. A significant spike in energy prices would reignite inflation concerns and put the Fed in an impossible position. They'd have to choose between fighting inflation with higher rates, which would hurt the economy and markets, or tolerating higher inflation, which would hurt credibility and purchasing power. Neither option is good when stocks are already expensive. So what should you actually do with this information? Because knowledge without action is pointless, but action without thought is dangerous, and panic is the worst response of all. First, take an honest inventory of your situation. How much of your net worth is in stock? What's your timeline for needing the money? How would you feel and what would you do if stocks fell 30 or 40% over the next year? These aren't hypothetical questions designed to scare you. They're planning exercises that every investor should do regularly. regularly, especially when valuations are elevated. If you're young, decades from retirement, high stock exposure makes sense even at elevated valuations because you have time to weather volatility and benefit from long-term growth. Time is your advantage. You can buy more shares when prices are lower. You benefit from dollar cost averaging. You don't need the money anytime soon, so temporary declines don't matter. If you're close to retirement or planning major expenses in the next few years, having 80 or 90% in stocks at current valuations is taking unnecessary risk. It doesn't mean sell everything and hide under your bed. It means consider whether your allocation still matches your actual situation and risk tolerance. Second, understand what you own and why you own it. If your portfolio is heavily concentrated in the most expensive sectors, technology and AI stocks in particular, you're taking on extra risk, not because those companies are bad. They might be excellent businesses with great futures, but because they're priced for optimistic scenarios. They need everything to go right to justify current valuation. Consider whether you want that much concentration or whether spreading risk across sectors that are more reasonably valued makes sense. Consumer staples, healthcare, utilities, these aren't exciting. They won't make you rich quickly, but they tend to hold up better when growth stocks stumble. They provide dividends that give you income even when prices aren't rising. They offer stability when everything else is volatile. Third, and this is perhaps most important, have an actual plan for what you'll do if markets fall. Not a vague idea. Not a hope that you'll stay calm. An actual, written plan. At what point would you add to positions because prices are becoming attractive? At what point might you reduce exposure because the decline is becoming severe? What would trigger those decisions? Is it a percentage decline? A valuation level? A change in economic conditions? Having that framework now, when you're calm and rational, is infinitely better than trying to make decisions in the middle of a crash when you're terrified. And headlines are screaming disaster, and your portfolio is down 40%. Here's something that almost nobody talks about, but matters enormously for long-term wealth building. The biggest gains in investing don't come from avoiding every decline. They come from being positioned to buy when assets are cheap. Cash doesn't grow. That's true. It doesn't generate return. But it also doesn't shrink when markets crash. And when markets do crash, cash gives you the ability to buy assets at reasonable prices instead of being forced to sell at the worst possible time because you need money for living expenses or because the psychological pain becomes unbearable. Right now, with valuations at historic highs and the Fed chairman warning about overvaluation, holding some cash isn't being scared. It's not market timing. It's being smart. It's recognizing that the risk-reward setup is terrible. You might make another 10 or 20% if the bubble keeps inflating, but you could lose 50% or more when it pops. That's not a bet worth taking with money you actually need. Here's the key insight that changes everything. At current valuations, even if stocks keep rising, your long-term returns are likely to be modest anyway because you're starting from such elevated levels. So the opportunity cost of holding some cash is lower than it would be if stocks were cheap. You're not missing out on much by being cautious when the market is expensive. Let me be very clear about what I'm not saying, because nuance matters and people tend to hear what they want to hear. I'm not predicting a crash. I'm not telling you to sell everything and hide under your bed. I'm not saying the market will definitely fall next month or next year. Markets can stay expensive for years. The 1990s proved that beyond any doubt. Technology genuinely does drive productivity growth and can justify higher valuations over time. Jerome Powell broke protocol to tell you something important. Stocks are fairly highly valued. He can't tell you what to do about it because that's not his job. That's your decision. But ignoring the message because markets might keep rising for a while is a choice, not a strategy. Understanding the risk, adjusting your exposure accordingly, having a plan for multiple scenarios, being prepared mentally and financially for volatility, that's actually having a strategy. And in expensive markets with uncertain futures and multiple cross-currents from tariffs to debt to inflation to geopolitics, having a real strategy is the most valuable thing you can do.